As of this exact moment, Arrowhead Pharmaceuticals, trading under the ticker symbol ARWR, is priced at $52.38, experiencing a sharp and aggressive intraday decline of approximately 9.2%. The market is currently seeing a significant flush, with volume surging past 1 million shares in the early trading hours, indicating a heavy rotation of capital rather than a simple lack of interest. Seeing a stock drop nearly 10% just days after a major regulatory victory and a strong earnings report is the kind of price action that leaves the average retail investor staring at their screen in confusion, wondering if they missed a fine print disaster in the press release. This price action creates a perfect tension between expectation and reality. The expectation was sky high. Arrowhead just secured FDA approval for its lead drug REDEMPLO, also known as plozasiran, on November 18th, marking its transition from a clinical stage hopeful to a commercial stage reality. On top of that, they reported fiscal year-end results that included a massive revenue spike driven by milestone payments. The logical expectation was a victory lap, a continued surge toward new highs. The reality, however, is a textbook sell the news event, where institutional liquidity is exiting to lock in profits from the run-up that occurred over the last few months. While the red numbers on the screen look alarming, the underlying reality is that the fundamental thesis of the company has arguably never been stronger. The market is mechanically adjusting valuation models now that the speculative premium of "will they get approval" has been replaced by the execution risk of "can they sell the drug?" This drop is not a failure of the science, it is a recalibration of the shareholder base. When you look at the broader market context, you see this behavior all the time with high-growth assets. It is not unlike the volatility you might see in Tesla stock after a highly anticipated delivery number is met, but not exceeded, or the way Nvidia stock can shed billions in market cap on a day when the broader semiconductor sector takes a breather. The difference here is the sector. Biotech is binary. You either have a drug or you do not. Arrowhead now has the drug. If you are managing your own capital through Schwab Intelligent Portfolios or using SoFi Invest to manage a more aggressive slice of your wealth, you have to distinguish between a broken stock and a broken company. Today's price action suggests a broken stock in the short term, but the company itself has just cemented its legitimacy. Let's look closer at the trading dynamics we are seeing right now. The stock opened near $56.39 and immediately faced selling pressure, slicing through the $55 and $54 levels with little resistance. This tells us that the smart money, the institutional algorithms and hedge funds, were likely queued up to sell into any remaining strength. If you are using interactive brokers' trading platforms, you can likely see the depth of book showing sell walls stacking up every 50 cents. This is characteristic of funds unwinding positions they accumulated when the stock was trading in the 20s and 30s. They're not selling because they dislike the company. They are selling because their risk models dictate taking chips off the table after a 100% run-up in a year. However, for the individual investor using Robinhood stock trading apps or Fidelity mobile app to track their positions, this volatility can be terrifying. It feels like the floor is falling out. But let's challenge the bearish narrative that this drop implies. The general belief right now might be that the market sees a flaw in the commercial launch plan or fears competition from Ionis Pharmaceuticals. My contrarian take is that this pullback is the most healthy thing that could happen for the long-term chart. It flushes out the weak hands who are only here for the FDA approval pop and resets the technical indicators, like the RSI, which were flashing overbought signals for weeks. We are seeing a transfer of ownership from momentum traders to long-term growth investors who want exposure to a validated RNA interference platform. Now let's analyze the catalyst that everyone is talking about. The FDA approval of REDEMPLO for familial chylomicronemia syndrome, or FCS, is a massive validation of Arrowhead's proprietary TRiM platform. This is not just about one drug. If you look at Apple stock, you don't just buy it for the iPhone, you buy it for the ecosystem. Similarly, Arrowhead isn't just a company with a triglyceride-lowering drug. They are a platform company. Their targeted RNA molecule, or TRiM technology, is the engine. It allows them to silence specific genes with high precision. The approval of plozasiran proves that this engine works in humans, is safe enough for the FDA, and can be manufactured at scale. That significantly de-risks the rest of their pipeline. The financials released just days ago further complicate the picture, but in a good way. The company reported revenue of over $800 million for the fiscal year, a staggering increase compared to the previous year. This wasn't from selling pills yet. It was largely due to a strategic move with Sarepta Therapeutics. Arrowhead earned a $200 million milestone payment from Sarepta, and, interestingly, they elected to take $50 million of that in cash and $50 million in Sarepta stock, effectively betting on their partner. This cash infusion extends their runway significantly. If you are looking at Fidelity Investments research or reading through Interactive Brokers account reports, you know that cash runway is the single most important metric for a biotech company launching its first drug. Commercial launches are expensive. You need sales forces, marketing materials, and distribution logistics. The fact that Arrowhead has a war chest and milestone revenue streams coming in means they are less likely to dilute shareholders with a desperate secondary offering right when the stock is down. Despite the 9% drop today, we have to look at the volume. It is high, but it is not panic-level capitulation. It looks more like structured distribution. If you compare this to the way Robinhood crypto markets move, which is pure sentiment and adrenaline, the selling in Arrowhead today feels calculated. It's hitting technical support zones. The stock recently hit a 52-week high of $59.15. Retracing 10 to 15% from a fresh high is standard operating procedure for high beta stocks. I want you to take a second and think about your own portfolio. Comment below how many shares of Arrowhead Pharmaceuticals you currently hold and what your average buy-in price is. Are you in the green from the 30s, or did you buy the breakout in the 50s? And also let me know if you think the market is overreacting to the sell the news phenomenon. Moving deeper into the fundamental analysis, we need to talk about what REDEMPLO actually does. It treats FCS, a rare genetic disease where patients have extremely high triglyceride levels leading to potentially fatal pancreatitis. These patients had virtually no options before. This is not a Me Too drug entering a crowded market like a new statin. This is an orphan drug with high pricing power. While the population is small, estimated at around 6,500 in the U.S., the reimbursement landscape for rare diseases allows for significant revenue per patient. This is why the SoFi investing crowd and those using Schwab Intelligent Portfolios need to look past the headline niche market and understand the high-margin reality. Furthermore, the pipeline behind REDEMPLO is robust. They have zodasiran, which is targeting angiopoietin-like protein 3, another lever for controlling lipids. They have programs in pulmonary issues and muscle diseases. The success of the first drug acts as a proof of concept for the delivery mechanism to the liver. The big question for the future and the source of the contrarian bullishness is whether the TRiM platform can effectively target tissues outside the liver. If Arrowhead proves they can silence genes in the lungs or muscles with the same efficacy they've shown in the liver, the total addressable market for this company expands exponentially. It would be comparable to when Amazon went from just selling books to selling cloud computing. It changes the valuation multiple entirely. Let's pivot back to the technicals on the chart because that is what matters for the next week of trading. Today's drop to $52 threatens to break the short-term uptrend, but there is massive support around the $48 to $50 region. This was the breakout zone that the stock struggled to clear for months. Old resistance often becomes new support. If you are an active trader using Robinhood app or Interactive Brokers platform, you are likely seeing the 50-day moving average. As long as the stock stays above that structural trend line, the long-term bull thesis remains intact. The Relative Strength Index, or RSI, on the daily chart was pushing 80 last week, extremely overbought. This cooldown brings it back toward neutral territory, giving the stock room to breathe and potentially base for the next leg up. We also have to consider the institutional landscape. Fidelity mutual funds and Fidelity ETFs that focus on biotech have likely been rebalancing. When a stock in a specialized ETF doubles in a short period, the fund manager is often forced to sell shares simply to maintain the target weight of the position in the fund. This mechanical selling can create downward pressure that has nothing to do with the company's merit. This is an inefficiency that savvy individual investors can exploit. If you are using self-investing tools or investing sites,